Introduction. What are you doing, Nina?
I'm counting my money.
How much do you have?
I have 10,000 rupees. I don't have enough to buy a new laptop.
Okay, let's buy it next year.
Mama, why not now?
Nina, you don't know how expensive it is.
You mean we will have to save up for it, right?
Yes, that's the thing. We often hear such conversations. Financial planning is useful for making provisions for such incidences. Financial planning. Everyone requires money to meet a variety of needs. That is why, after spending on the necessities of the present, everyone tries to save money to make provisions for the future needs. Every investor first spends the amount required to meet primary necessities and saves the remaining amount. One also uses these savings to make carefully considered investments. This is called financial planning. The main purpose of financial planning is protection and growth of the wealth. Many predictable and unpredictable incidences occur in our life. Predictable expenses, education of children and other expenses, capital for a profession and business, buying a vehicle, buying or building a house, old age requirements. Unpredictable expenses, natural disasters, medical expenses for a family member, loss due to an accident, sudden death. Savings and investments. Savings. It is for our own benefit to keep our savings safe and to make them grow. Our savings remain safe in a bank or in a post office. Money saved in a bank is also useful for cash minus transactions. So, we do not have to carry large amounts of cash or worry about losing it or getting it stolen. If the money we get or earn is in the form of cash and we keep it as it is without investing it, its value diminishes with time. For example, if today you can buy 2 pencils for 10 rupees, a few years hence, you may be able to buy only one for that amount. If the amount invested is used for expanding a business, to start an industry or other such purposes, it contributes to the growth of the national production. If some part of the income is spent for a socially useful cause, everyone benefits from it in the long run. After spending on necessities, it is beneficial to limit spending on luxuries and to save instead for education, medical treatment, etc. Investments. There are many types of investments. Investors often favor institutions like banks and postal departments for investing their money because it is safe there. There is a certain risk in investing money in shares, mutual funds, etc. That is because this money is invested in a business or industry, and if that incurs a loss, the investor suffers the loss too. On the other hand, if it makes a profit, the money is safe and there is the opportunity to get a dividend too. An investor must take two important points into account when making an investment, namely the risk and the gain. It is possible to make big gains by taking greater risk. However, it must be kept in mind that the greater risk can also be led to greater loss. Activity. Rita invested some part of 35,000 rupees at 4% and the rate at 5% interest for 1 year. Altogether, her gain was rupees 1,530. Find out the amounts she had invested at the two different rates. Write your answers in the blank spaces. Solution. Word problems. 1. Alka spends 90% of the money that she receives every month and saves rupees 120. How much money does she get every month? Solution. Suppose Alka receives rupees Y per month. She spends 90% of the money she receives. Therefore, she spends 90% of rupees Y is equal to 90 upon 100 into Y is equal to rupees 9Y upon 10. Savings is equal to income minus expenditure. Therefore, 120 is equal to Y minus 9Y upon 10. Therefore, 120 is equal to 10Y minus 9Y upon 10. Therefore, 120 is equal to Y upon 10. Therefore, 120 into 10 is equal to Y. Therefore, Y is equal to 1200. Answer. Alka receives rupees 1200 per month. 2. Sumit borrowed a capital of rupees 50,000 to start his food products business. In the first year, he suffered a loss of 20%. He invested the remaining capital in a new sweets business and made a profit of 5%. How much was his profit or computed on his original capital? Solution. 20% loss on investment of rupees 50,000. Therefore, loss is equal to 20% is equal to 20 upon 100 into 50,000 is equal to 20 into 500 is equal to rupees 10,000. The capital of Sumit at the end of the year is equal to original capital minus loss is equal to rupees 50,000 minus 10,000 is equal to rupees 40,000. Sumit invested rupees 40,000 in a business of sweet. Now he made 5% profit. Therefore, profit is equal to 5% of 40,000 is equal to 5 upon 100 into 40,000 is equal to 5 into 400 is equal to rupees 2,000. The capital on hand is equal to rupees 40,000 plus 2,000 is equal to rupees 42,000. The new capital is less than the original capital. Therefore, Sumit incurred a loss. Loss is equal to original investment minus investment in hand is equal to rupees 50,000 minus 42,000 is equal to rupees 8,000. Percentage loss is equal to loss upon original capital into 100 is equal to 8,000 upon 50,000 into 100 is equal to 80 upon 5 is equal to 16. Answer. Sumit incurred 16% loss. 3. Mr. Syed kept rupees 40,000 in a bank at 8% compound interest for 2 years. Mr. Fernandez invested rupees 1,20,000 in a mutual fund for 2 years. After 2 years, Mr. Fernandez got rupees 1,92,000, whose investment turned out to be more profitable. Solution. Mr. Syed kept rupees 40,000 in a bank at 8% compound interest for 2 years. A is equal to P 1 plus R upon 100 raised to N. Here, A is equal to amount, P is equal to principal, R is equal to rate of interest, and N is equal to number of years. Therefore, A is equal to P 1 plus R upon 100 raised to N is equal to 40,000 1 plus 8 upon 100 raised to 2 is equal to 40,000 100 plus 8 upon 100 raised to 2 is equal to 40,000 108 upon 100 raised to 2 is equal to 40,000 into 108 upon 100 into 108 upon 100 is equal to 4 into 108 into 108 is equal to rupees 46,656. Therefore, interest is equal to amount minus principal. Therefore, I is equal to 46,656 minus 40,000. Therefore, I is equal to rupees 6,656. Sayyid's profit percent is equal to 6,656 upon 40,000 into 100 is equal to 6,656 upon 400 is equal to 16.64%. 1. Fernandez invested rupees 1,20,000 in mutual fund for 2 years. He received rupees 1,92,000. Therefore, the profit earned by Fernandez is equal to 1,92,000 minus 1,20,000 is equal to rupees 72,000. Fernandez profit percent is equal to 72,000 upon 1,20,000 into 100 is equal to 720 upon 12 is equal to 60%. 2. Answer. Fernandez's investment is more profitable. 4. Samira spent 90% of her income and donated 3% for socially useful causes. If she left with rupees 1,750 at the end of the month, what was her actual income? Solution. Answer. Samira's monthly income is rupees 25,000. 5. Nikhil spent 5% of his monthly income on his children's education, invested 14% in shares, deposited 3% in a bank, and used 40% for his daily expenses. He was left with a balance of rupees 19,000. What was his income that month? Solution. What is a tax? A fee charged by a government on a product, income, or activity. Tax is an amount of money that you have to pay to the government so that it can pay for public services. One of the most important uses of taxes is to finance public goods and services such as street lighting and street cleaning. Very good, Joseph and Kedar. Whose parents pay taxes? My father is a doctor. He pays income tax and professional tax. My father is a farmer. He does not have to pay income tax on agricultural income. My mother is a teacher. She pays income tax. Our electricity bill includes a service tax. Let's see more information about taxes. The government makes many plans for the development of the country. It requires large amounts of money for implementing these schemes. By charging different types of taxes, the funds are generated for implementing of these schemes. Utility of taxes. Provisions of infrastructure, basic amenities, implementing various welfare schemes, implementing schemes of development and research in various fields, maintaining law and order, giving aid to people affected by natural disasters, defense of the country and its citizens, etc. Types of taxes. Direct taxes. Taxes which are paid directly by the taxpayer are called direct taxes. For example, income tax, wealth tax, profession tax, custom duty, etc. Indirect taxes. Taxes which are not paid directly by the taxpayer are called indirect taxes. For example, central sales tax, value added tax, VAT, service tax, excise duty, etc. In this lesson, we shall consider only those taxes which are to be paid by individuals. Income tax. If the income earned in India by an individual, institute, or authorized industry exceeds the limit specified under the Income Tax Act, income tax is levied on it. Income tax is levied by the central government in India. Income tax is levied under following two acts. 1. Income Tax Act 1961, which came into force on 1st April 1962. 2. The act passed every year by Parliament which makes financial provisions. Every year, sometimes in February, the Finance Minister presents the budget for the next financial year. It has proposals for the income tax rates. Once the Parliament passes the budget, the proposal rate becomes applicable for the following year. Income tax rates are fixed every year in the budget. Some income tax related terms. An SSE. Any person liable to pay income tax according to the income tax rules is termed as SSE. Financial year. The period of 1 year during which the taxable income has been earned is called a financial year. In our country, the financial year is from 1st April to 31st March. Assessment year. The financial year immediately following a particular financial year is called the assessment year. The tax payable for the previous financial year is calculated during the current year. That is the assessment year. Financial year and assessment year will be clear from the given table. Permanent account number, PAN. On applying for it, every taxpayer gets a unique 10-digit alphanumeric number from the Income Tax Department. We are required to mention this number in many important documents and financial transactions. PAN card can also be used as proof of identity. Computation of income tax. As income tax is a tax levied on income, the different sources of income are as follows. 1. Income from salary. 2. Income from house or property. 3. Income from business or profession. 4. Income from capital gain. 5. Income from other sources. Important considerations for computing income tax. The total annual income, gross total income, is taken into account for calculating the tax payable. According to sections 80C, 80D, 80G, etc. of the Income Tax Act, some deductions can be availed from the total annual income. The amount remaining after these deductions are made is called taxable income. Income tax levied on this taxable income. No tax is levied up to a certain limit of taxable income. This is called the basic exemption limit. Farmers' income from the agricultural produce is exempt from taxation. Under Section 80G of IT Act, donations to Prime Minister's Relief Fund, Chief Minister's Relief Fund, and certain other donations to recognized institutions or organizations are exempt from taxation. Under Section 80D, installations of premium for health insurance are exempt from taxation. Generally, the maximum permissible deduction to various kinds of savings under Section 80C is Rs 1,50,000. Activity. Tax rates according to the age of taxpayers are fixed in each year's budget. Samples of tables showing tax rates for different income slabs are given. Activity 1. Use Table 1 and write the appropriate amount or figure in the boxes for the given example. Example: Mr. Mehta's annual income is Rs 4,50,000. If he does not have any savings by which he can claim deductions from his income, to which slab does his taxable income belong? Answer: Rs 2,50,001 to Rs 5 lakh. What is the amount on which he will have to pay income tax and at what % rate? Answer: on Rs 2 lakh, % is 5. On what amount will the cess be levied? Answer: Rs 10,000. Activity 2. Use Table 2 to carry out the following activity. Example: Mr. Pandit is 75 years of age. Last year, his annual income was 13,25,000 rupees. How much is his taxable income? How much tax does he have to pay? 13,25,000 minus 10 lakhs is equal to 3,25,000. According to the table, he must first pay Rs 1,10,000 as income tax. In addition, on 3,25,000 rupees, he has to pay 30% income tax. Therefore, 3,25,000 into 30 upon 100 is equal to 97,500 rupees. Therefore, his total income tax amounts to 1,10,000 plus 97,500 is equal to 2,07,500. Besides this, education cess will be 2% of income tax. Therefore, 2,07,500 into 2 upon 100 is equal to 4,150. A secondary and higher education cess at 1% of income tax. Therefore, 2,07,500 into 1 upon 100 is equal to 2,075. Therefore, total income tax is equal to income tax plus education cess plus secondary and higher education cess is equal to 2,07,500 plus 4,150 plus 2,075 is equal to. Word problems. 1. Observe the given table. Check and decide whether the individuals have to pay income tax. Solution. 1. Age 27 years, below 60 years. Taxable income is equal to Rs 2,34,000. For this category, exemption up to Rs 2,50,000. Taxable income Rs 2,34,000 is less than Rs 2,50,000. Therefore, Miss Nikita will not have to pay income tax. 2. Age 36 years, below 60 years. Taxable income is equal to Rs 3,27,000. For this category, exemption up to Rs 2,50,000. Taxable income Rs 3,27,000 is greater than Rs 2,50,000. Therefore, Mr. Kulkarni will have to pay income tax. 3. Age 44 years, below 60 years. Taxable income is equal to Rs 5,82,000. For this category, exemption up to Rs 2,50,000. Taxable income Rs 5,82,000 is greater than rupees 2,50,000. Therefore, Ms. Mehta will have to pay income tax. 4. Age 64 years, age between 60 to 80 years. Taxable income is equal to rupees 8,40,000. For this category, exemption up to rupees 3 lakhs. Taxable income rupees 8,40,000 is greater than rupees 3 lakhs. Therefore, Mr. Bajaj will have to pay income tax. 5. Age 81 years, above 80. Taxable income rupees 4,50,000. For this category, exemption up to rupees 5 lakhs. Taxable income rupees 4,50,000 is less than rupees 5 lakhs. Therefore, Mr. De Silva will not have to pay income tax. 2. Mr. Kartar Singh, age 48 years, works in a private company. His monthly income after deduction of allowances is rupees 42,000 and every month he contributes rupees 3,000 to GPF. He has also bought rupees 15,000 worth of NSC, National Savings Certificate, and donated rupees 12,000 to the PM's Relief Fund. Compute his income tax. Solution. Mr. Kartar Singh's monthly income is rupees 42,000. Therefore, total yearly income is equal to rupees 42,000 into 12 is equal to rupees 5,04,000. His deduction A. GPF rupees 3,000 per month, therefore is equal to rupees 3,000 into 12 is equal to rupees 36,000. B. NSC is equal to rupees 15,000. C. PM's Relief Fund is equal to rupees 12,000. Therefore, total deduction is equal to 5,04,000 minus 36,000 plus 15,000 plus 12,000 is equal to 5,04,000 minus 63,000 is equal to rupees 4,41,000. According to table, rupees 4,41,000 is less than rupees 5 lakhs. Therefore, no income tax up to rupees 2,50,000. Therefore, rupees 4,41,000 minus 2,50,000 is equal to 1,91,000. Therefore, on 1,91,000 rupees, he has to pay 5% income tax. Therefore, 5% of rupees 1,91,000 is equal to 5 upon 100 into 1,91,000 is equal to 5 into 1,910 is equal to rupees 9,550. Besides this, education cess will be 2% of income tax. Therefore, 2% and rupees 9,550 is equal to 2 upon 100 into 9,550 is equal to 955 upon 5 is equal to rupees 191. A secondary and higher education cess will be 1% of income tax. Therefore, 1% of rupees 9,550 is equal to 1 upon 100 into 9,550 is equal to 955 upon 10 is equal to rupees 95.50. Therefore, total income tax is equal to rupees 9,550 plus 191 plus 95.50 is equal to rupees 9,836.50. Answer: Mr. Kartar Singh will have to pay rupees 9,836.50. 3. Total income of Ritesh, Sumit and Anna is 8,07,000 rupees. The percentages of their expenses are 75%, 80% and 90% respectively. If the ratio of their savings is 16:17:12, Then find the annual saving of each of them. Solution. Answer. The annual savings of Ritesh, Sumit and Anna are rupees 48,000, rupees 51,000 and rupees 36,000 respectively.